Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Sony's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or sell. Sony is one of the world's largest manufacturers of consumer electronics. It's also the largest video game company, the largest music company, and the third largest film company. It is headquartered in Tokyo, Japan, and was founded in 1946. It went public in 1970 and trades on the New York Stock Exchange, Deutsche Börse, Mexican Bolsa, London, Tokyo, Vienna, and Swiss stock exchanges. It is the largest Japanese media company. It is the largest manufacturer of image sensors, the second largest camera manufacturer, and it's also one of the top companies in semiconductor sales. It is the oldest listed Japanese company on the New York Stock Exchange. It's been listed over 50 years. Let's get started with the model. This is a large cap company, 123 billion market cap. They're trading at $99 a share and they have 1.2 billion shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. You can see they have a ton of free cash flow. It does go down. It was $9 billion in 2018. It's currently $7.6 billion. But still, $7.6 billion is a lot of money to work with. Net income is the profit and loss on the income statement. It's revenue minus expenses. And that peaked in 2021 at $10.6 billion. Revenue is the sales for the company, and that grew from $78 billion up to $82 billion in 2021. This is the company's income statement. All their financials are in Japanese yen. I converted their numbers to US dollars on my Excel spreadsheet since we're looking at the ticker that trades on the New York Stock Exchange. The top line is the revenue, the sales. That peaked at 9 trillion yen in 2021. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that was the highest in 2021. Below that is operating expenses. Gross profit minus operating expenses gives you your operating income, which was the highest by far in 2021 at 967 billion. They pay 12 billion of interest on their debt. It is lower than 2018 at 13.5 billion. Then below that is other income and expenses, which is usually asset impairments or the gain on the sale of an asset. And the bottom line of the income statement is their net income, which was the highest in 2021. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit and loss. It's not actual cash. You see how smooth operating cash flow is? It's pretty consistent year to year. When you look at their net income on their income statement, it's very volatile. That's what happens with accrual accounting. Things are all over the place. But when you look at cash, it's much smoother. Then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. And they have a lot of free cash flow each year. So you can see in 2019, 20, and 21, they repurchase a lot of stock with their free cash flow. When a company repurchases stock, that decreases the shares outstanding, making your shares more valuable. They also pay a dividend with their free cash flow. They paid down a lot of debt in 2019 and 2020, although they added debt in 2018 and 2021. When a company adds a lot of debt and has a lot of free cash flow, it's likely they're using that debt to acquire another company. Let's look at the capital structure. $51 billion of equity, 22 billion of debt. They're 69% equity, 31% debt, and their net debt is negative 20 billion. So they could pay down all the debt with the cash on their balance sheet and still have $20 billion of cash left over. Their WACC is 9%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 155 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $141 billion. We divide that by 1.2 billion shares. And we get a calculated stock price of 114. They're trading at 99, so they're trading at a 13% discount. It's a buy according to the model. Simply, Wall Street values the company at $30. I think this is a mistake in their database because I looked at some of the numbers used for the calculation. It looked like one of the numbers was incorrect. They didn't convert it to the correct currency. 3 analysts priced this stock and the average price target was 120, the low was 106, the high was 135. This top chart is the stock price since it started trading. It looks like it peaked at about $125, then came down pretty low to around $30. The past 2-3 years, the stock price has done really well. This is the stock price the last 12 months. So it looks like it's done well during COVID. It looks like it peaked at about $115, but it came back down to around $100. They pay a small dividend, 0.5%, which is lower than the industry average of 1.4%. Analysts are forecasting their dividend to grow to 0.7% in the next 3 years. Their beta is 0.75, so the stock moves less than the market. The stock has gone up 52% in the past 52 weeks, while the S&P 500 went up 38%. The 52-week high was 119, the low was 65, and the stock is trading below its 50-day and 200-day moving average. About 500,000 to 800,000 shares are traded each day on this stock. Almost all the shares outstanding are on float. Only 8% are held by institutions, and hardly any of the shares are shorted. In the past year, this stock has gone up 54%, while its industry went up 82% and the market 45%. But in the past 3 years and 5 years, this stock has outperformed its industry and the market. Analysts are forecasting their earnings to decrease 3.3%, its industry to increase 12%, and the market to increase 15%. Analysts are forecasting their revenue to grow 4%, its industry 9.5%, and the market 9%. In the past 5 years, their annual earnings increased 39%, its industry 18%, and the market 12%. In the past year, their earnings increased 101%, its industry 65%, and the market 20%. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $37,200 today. That's a 14% annual return. The biggest shareholder is Sumitomo at 6.5%, then Nomura, Vanguard, BlackRock, and PrimeCap. Let's look at their financial ratios. The average PE in the market's 33, the median is 22. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 11.6, so investors are paying $11.60 for $1 of earnings. That's much better than the market median and average. Their price to sales is 1.5, also better than the median average, and their price to book is 2.4, another good ratio. Their return on invested capital is 22.5%, that's a really solid number. They have a high current ratio of 79, they can easily cover their interest payments. ROE of 21%, way better than the market median and average. And their current ratio is 0.9, so they can cover 90% of their current liabilities with their current assets. Their current assets are 4.7 trillion yen of cash, 1.4 trillion of receivables, and 638 billion of inventory. They do seem to be well capitalized. They had 7.6 billion of free cash flow, negative 5.4 billion of working capital, and almost $600 million of dividend payments. So they have $1.6 billion of funding. The best way to look at ratios is to compare them to companies in the same industry. I've done videos on Samsung, Apple, and Koss, all in the same industry as Sony. And if Sony has a number in blue, they're better than the average. If they have a number in red, they're worse than the average. So they're a lot better in all the price multiples. They have the worst current ratio. They're lower than average in ROE. They're a little higher in debt than average. And they're a big company, but they're a lot smaller than Samsung or Apple. They do pay a dividend, but it's really small. So to summarize, I have them trading at a 13% discount. This is a giant of a company that's a great long-term hold because the stock is always going to be around. If you hold stocks for long-term, like 10, 20 years, there's a big risk that the company you buy won't be around that long. But this company definitely will be around. It plays such an important role in the Japanese culture. They supply a lot of jobs. Their products are shipped all around the world. And their brand name is respected all over the world. I rank their free cash flow 6 out of 10. Their revenue 8 out of 10, and their ratio is 8 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.